This presentation, which supports the CP3P qualification, the qualification for public-private partnerships that's accredited by APMG, is a simple introduction to infrastructure financing and structuring, and is in three parts. And the first part looks specifically at the purpose of project financing, and also looks at the structuring of it through a special purpose vehicle. CP3P, a simple introduction to infrastructure financing and structuring, cash flows and risk. And this is the second presentation of three regarding public-private partnerships and project finance. So first of all, let's look at figure 1.8 drawn from the CP3P guide produced by APMG. This is the public sector outflows, and it's a comparative chart between a conventional procurement and a public-private partnership. Now, under a conventional procurement or traditional procurement, the government pays for construction as it progresses and then is responsible for maintenance and other running costs as they arise. Under a public-private partnership, the public sector pays a pre-agreed price with a service provider for usage of the facility during the life of the contract, and only when the services commence. Meanwhile, the private sector pays for construction as it progresses and is responsible for maintenance and other running costs as they arise. So we can see here that the amount that the public sector is paying during that period of service operations is slightly higher than it would be under a conventional procurement. But then on the other hand, the public sector has not made any upfront capital payments, and indeed the service delivery is the quality of that service delivery is what will cause the private sector to be paid. Now, let's look at the risk profile of one of these deals. So here we're going to show the risk over time for a typical public-private partnership. So we've got risk cost up on the left-hand side, and running across the bottom is time or years. Now, there are effectively two periods for a PPP. One of them is the build phase, and that's followed by the operational phase. However, towards the end of the operational phase, we have a period which is prior to handback, before the asset is returned to the public sector. And during that period, the private sector SPV may have to put money into maintaining some of the assets, such as a roof and so on. So that becomes a more risky period. So let's continue to look at the risk profile of a typical public-private partnership. So here we have the line, which is the perceived level of risk in the deal at any point in time. And that is shown as being very high during the first period, during that construction period. And that's the period during which the SPV will be drawing down its loan from the bank in order to pay its building contractor. Then we move into the operational period, when the risk falls dramatically. Although initially there might be some additional level of risk associated with setting up the services, with setting up the systems associated with the delivery of the contract. As we move towards the end of the contract period, so let's say this was a 25 to 30-year deal, we might be in that period, say between year 15 and 22, where there'll be a bit of a hump in risk, because we might see that some of our infrastructure, some of our M&E might not be operating effectively and might need to be replaced. Of course, we will have set aside a maintenance fund as we were going through each year of the contract to pay for any issues that might arise like this. And then finally, in that handback period, there may be, again, some additional risk. We know that we're going to call in the independent engineer or independent certifier to look at the asset, and they will take a view on whether or not there is sufficient life left in certain parts of the asset that have been specified in the contract that go beyond contract term, let's say for 3 to 5 years. And if the asset is not sufficiently robust in that way, then the expectation is that the SPV will have to restore, let's say, the quality of the roof and to put it in good order, at least so that it is sufficiently robust to last for the period that has been demanded in the contract at the beginning of the contract, maybe 25, 30 years earlier. So we have initially the start of our contract where all the risk is ahead of us. Post-construction, where the risk has dropped considerably, we might now think about refinancing our loan, or perhaps we will have had a 3 to 5 year relatively short-term loan, and now we are going to be looking at bond finance for the rest of the contract period. The risk then increases as we move to that sort of mid-life period of the contract, and then ultimately we get to the end of the contract, and although the risk is maybe increasing, there's a possibility that the asset is fully in good order and the independent certifier has signed it off, and we can simply move to term. In which case, if there is a fund that's been put together associated with the maintenance around handback, then that fund can be released to the equity shareholders. So we could either have loan finance that is throughout the whole period of the contract, although that actually became quite difficult to obtain after the financial crisis in 2007, 2008. And more likely, we'll see that there will be a loan followed by bond finance. Okay, so that's a quick introduction to project finance and special purpose vehicles. Part 2 of this presentation will look at cash flows and risk throughout the life of the SPV and the public-private partnership. Thank you.